If you're looking for a low-risk investment with a guaranteed return, I-bonds could be worth considering. They are US government-issued savings bonds that have a few unique features, and they offer a combination of security and inflation protection. This guide will cover what I-bonds are, how they work, their benefits and drawbacks, and strategies for maximizing returns. What are I-bonds? I-bonds stand for inflation-indexed bonds. They are a type of savings bond that the US government issues as part of its borrowing program. I-bonds were introduced in 1998 as a way to provide a low-risk investment option that protects investors from inflation. They have a fixed interest rate that lasts for the life of the bond, and a variable inflation component that changes twice a year based on the Consumer Price Index for Urban Consumer CPIU. How do I-bonds work? I-bonds can be purchased online via the US Treasury's website or in paper form at some banks and credit unions. The minimum purchase is $25, and the maximum purchase for electronic bonds is $10,000 per Social Security number per calendar year. Bonds can be held for up to 30 years, and they earn interest for the entire time they are held. There is no secondary market for I-bonds, which means they cannot be sold or traded on stock exchanges. The interest rate for I-bonds consists of two parts, a fixed rate and a variable rate. The fixed rate is determined at the time of purchase and is based on the current market rates. The variable rate is adjusted every 6 months based on the CPIU. The combination of the fixed and variable rates determines the total interest rate you will earn over the life of the bond. One noteworthy feature of I-bonds is that the interest they accrue is exempt from state and local income taxes. Additionally, they are not subject to federal income tax until you redeem them or they reach maturity. What are the benefits of investing in I-bonds? I-bonds offer a few benefits that make them attractive to investors. One of the most significant benefits is that I-bonds are one of the few investments that protect against inflation. The variable inflation component means that your bond will always earn more than the rate of inflation, even if interest rates go down. Another benefit of I-bonds is their low-risk nature. Because they are issued by the US government, they are considered to be one of the safest investments available. Unlike stocks, I-bonds are not subject to significant fluctuations in value, and investors are guaranteed to receive their principal back when they mature. Finally, I-bonds are easy to purchase and manage. You can buy and sell them online, and they require minimal upkeep beyond tracking the interest rate updates that occur twice per year. What are the drawbacks of investing in I-bonds? While I-bonds have several benefits, they also have a few drawbacks that investors must consider. The first is that their interest rates are relatively low compared to other investments. For example, as of September 2021, the fixed rate for I-bonds was 0.00, while the variable rate was 3.54. This means that while I-bonds are low risk, they may not provide substantial returns. Another consideration is that I-bonds have a relatively long maturity period. If you need access to your money before the 30-year mark, you must pay a penalty equal to 3 months' interest. This can make I-bonds less attractive to some investors who need more flexibility with their money. Finally, I-bonds have an annual purchase limit of $10,000 per Social Security number per calendar year. This purchase limit may be a hindrance to those who want to invest more money in a low-risk investment. What are strategies for maximizing returns with I-bonds? If you decide to invest in I-bonds, there are a few strategies you can use to maximize your returns. One strategy is to purchase I-bonds during a low interest rate environment. When interest rates are low, the fixed rate component of I-bonds will also be low. However, because the variable rate component of the bond is tied to the CPIU, it will continue to increase as inflation rises. Another strategy is to invest in I-bonds in small increments over time. By investing small amounts on a regular basis, you can take advantage of the current interest environment without risking a significant amount of capital in one go. This strategy is known as dollar cost averaging. Finally, you can use I-bonds as a way to diversify your investment portfolio. Because they have a low correlation to other stocks and bonds, I-bonds can help reduce the overall risk of your investment portfolio. Let's look at a real-life example to illustrate how I-bonds might work in practice. Say you invested $1,000 in an I-bond with a fixed rate of 0.00 and a variable rate of 3.54. After 1 year, your bond would be worth $1,035.40. If inflation continued at a steady rate of 3 per year, after 10 years, your bond would be worth 1,400.72. That's an annualized return of 3.54, which is better than most savings accounts or certificates of deposit. If you held onto your I-bond for 30 years, it would be worth 2,066.85. That's an annualized return of 1.83, which is relatively low compared to other investments. However, it's still a low-risk investment that provides inflation protection, making it a suitable option for some investors. In summary, I-bonds are US government-issued savings bonds that offer low-risk investment options with guaranteed returns. They have a unique combination of a fixed rate and variable inflation component that provides inflation protection to investors. While I-bonds have relatively low interest rates, they are a valuable addition to any investment portfolio because of their low-risk nature and guaranteed returns. By using the strategies outlined in this guide, you can maximize your returns and take advantage of the benefits that I-bonds provide. How do you feel about I-bonds? Are they a good investment? Comment below. What other subjects would you like to have videos on? Thanks for watching Free Market Economy.